Order, 9 a.m. Would like to ask as a courtesy that you silence your cell phones and mute your connection if you joined us on Teams. Each director received notice of this committee meeting. The public meeting notice was properly posted as required by law. Directors, for the attendance record, when your name is called, please unmute yourself and let us know that you are here. Christy or Lisa, please call on each committee member to record the attendance.
Chairman Luton.
Here.
Director Taylor.
Who was that?
Director Taylor.
Here.
Director Henderson.
Here.
Director Leslie.
Here.
Director Tallis.
Here.
President Officer Flores.
Here.
We do have a quorum of the committee present. We will now move to the public comment section of our agenda. For those commenting, please note the committee may not deliberate items that are not posted on our agenda. Additionally, we do not plan to place a time limit on public comment unless we feel the time being taken is affecting others' ability to address the committee. We have no one signed up to speak in the public comment section. Is anyone wanting to speak that did not sign up? We will now proceed to the regular agenda. During this special committee meeting, we are only addressing agenda item 1, the selection of retirement plan advisory services. Agenda items 2 and 3 will not be covered at this time. These reports have been uploaded and convened for your information. If there are any questions, we can address them after agenda item 1. Agenda item 1 is discussion and possible action on selection of retirement plan advisory service by David Thompson, Chief Financial Officer. David?
Good morning. I just want to give you a little background on what's going on here. ANCO has been with us for 5 years, and their contract is due to be completed here in the next couple of months. So we went back out for a solicitation, and we had 6 firms that did respond to the solicitation back in January. My staff and I narrowed those 6 firms down to 3. And so we have 3 firms this morning, each giving 30 minutes. And in the 30 minutes, they'll have 20 minutes of presentation and then 10 minutes worth of question and answers. And then there's a 15-minute between each group. And my goal is to finish this thing up around 11:30 at the time. So with that, let me share my screen. Can everyone see the screen?
Yes.
Okay, I will turn it over to Tony and Jack and I'll just guide through the pages and I'll turn them for you.
Well, very good. Thank you, Tony K here. Nice to see you all virtually. Jack Evett, consulting director with our firm, is on as well. So certainly want to thank you for this opportunity to provide you with an update and an overview of ANCO. Again, wish we were all convening in person. I personally miss my trip down to Waco and stopping at Slovacek's for a kolache, but my waistline appreciates that I don't have that option today. So again, Jack Evett and I will walk through the presentation. What we'd like to do again is give you a firm update and kind of talk about what's changed at ANCO, the enhancements that we've made at ANCO over the last 5 years. Got a lot of resources, team members, and wanted to talk about that with you. And then also spend some time just talking about the portfolio and some of the improvements that we've seen over the last 5 years. Certainly hope this will be an interactive presentation. So if you have questions or comments throughout, please interrupt us. We want this to be productive and the best utilization of your time. And we'll certainly do everything we can to keep you on schedule. So Jack, with that, if you want to take over the first few slides with comments about the firm updates.
Thanks, Tony. Thank you all for the opportunity today and really for the opportunity to be your consultant for really the last almost 10 years now. And I will cover, like, as Tony said, some of the general firm comments. I think you know us pretty well, but we are a pretty dynamic organization. And so I want to cover some of the things that have happened in the last 5 years and really even more recently than that. So if you could page forward to page 4 for me.
Hang on 1 second.
Sure.
Board here. There it is.
Chair Luton, I've got a quick question. I'm looking at my iPad and I see that it's changing here. Will I see those same changes on the screen that were the shared screen, or did I miss something in that?
That question I can't answer. Can you see the ANCO presentation, Director Henderson?
I can, yeah. I'm just
Okay.
curious if I'm in convene too, will it be the same in both places?
Yes, it will.
Okay.
Okay. These virtual presentations are certainly a challenge. I'll tell you what. We would have loved to have been there, as Tony said, in person. Unfortunately, that is not the case, and maybe that's preferable for you guys. I wouldn't want a bunch of people flying in either for these things. But here's kind of some of the things we're going to talk about today. We're going to try to keep this short, since you do have some familiarity with our firm. But I'll cover the firm. Tony's going to cover some of the services and team process and execution. We've included a lot of stuff in the appendix. I think it's there for your use. If you have any questions, we'd like to be able to refer to it if we can. But stuff about the research process and the research group in particular is in there. If you have an interest in thumbing through that. And Mr. Thompson, could you go forward 2 pages for me, please? Okay. Oh, there you go. All right. Thank you. So here's who we are. We are ANCO Consulting. We've been in business for a little over 20 years as an institutional investment consultant. We have just under $100 billion in assets under advisement. As you can see there, 96. We reinvest 100% of our profits. I think that's important, and I think you'll see some of the benefits of that, both hopefully through some of the services that we provide you currently, but also in some of the things that we've done over the last few years. I'm going to highlight that. We are institutionally focused only. We only do investment consulting. I think that's very, very important. We have one line of business. And if you have multiple lines of business, I think you have to make a determination as to where the money goes. A lot of times that goes to the highest profit margin business, and institutional investment consulting, I'm pretty sure, is not the highest profit margin business for almost anything. So a lot of times what happens is it gets resource starved to a certain extent. So from our standpoint, it's all we do, and I think that's important to you. We have over 91 employees. You can kind of see the credentials there listed on the right-hand side. A lot of them are really, really smart. Particularly on the research group and the consulting side. They have a lot of experience and a lot of education and working in this field. We have a client service culture. What does that mean? We like to build partnerships with our clients. We got to get to know what's important to you. It helps us advise you on things that happen in the portfolio and in the plan. What that's resulted in a retention rate annualized to over 98%. We are truly independent. Like I said, we are a fiduciary without exception. We don't have license to sell products. We don't have our own investments. We have complete open architecture with all vendors, meaning that we don't have people who pay us to promote their investments. And we have no direct, indirect manager compensation. All we do is investment consulting, and I think that's in the best interest of all of our clients. Any questions about this page before I go on? Okay, could you go forward one more page, please, Mr. Thompson? Thank you very much. So what does independence mean? It means we're not affiliated with a broker dealer. I think you guys all know this. I think based on the RFP that you sent out and the choices that you made in the past, I think this is important to you as well. But I just want to cover it briefly, just because it is, we think, critical in this business. There are a lot of people who claim to be independent that aren't. So affiliated with a broker dealer, licenses to sell things or get paid for things. I think it's also important to know that we're not involved in litigation. We've never been sued by a client. We're not owned by a holding company that may own other affiliated types of business that can create conflicts for us. We don't sell managed accounts. We don't sell our research. All of our research is done for the benefit of our clients. One more page forward, Mr. Thompson, please. Okay, so that's kind of the big picture stuff. Hopefully some of that was familiar to you, but I think what's really important is what has happened more recently in the last 5 years, really almost 6 years now since that we started this last agreement with you. I wanted to kind of take some time to highlight some of the things that have changed with our firm during that period of time. So one of the things that I talked about was 100% reinvestment. What does that mean? It means since 2015, we've had 25 additional employees. I think what's important about that is where those employees are. We are an investment consulting firm. That's how we make our money. Yet only 16% of those hires have come in investment consulting. The rest of those have come in related fields to support the clients that we have. 10 research analysts, 4 people in the client service group. Those are the people that actually do the quarterly reports that you see and any kind of performance monitoring calculations. We have 3 people in marketing. For us, marketing is really more the creation of things like this deck today for RFP purposes and kind of making the things that we put out look professional and nice. We have 1 new compliance analyst, 1 person in HR, 1 controller, and 1 payroll benefit specialist. So 56% of the people that we've brought in since 2015 really are people that directly contact our clients, research analysts, client support groups. I think that's important to you. Diversity is a big focus for us. We're working to try to make sure that our firm is inclusive in our hiring practices, but it's also important that we look at the firms that we promote to our clients in terms of investment managers and what that group looks like too. Providing opportunity for MWB has really been a focus for us. So if you could go forward one more page, Mr. Thompson. Thank you. So here's our organizational chart. I don't want to spend a ton of time on this, but I think it's really pretty impressive. I think on the right-hand side, you can see the number of research analysts that we have, cover a lot of different spaces. Those people work directly with your investment consultant and with clients to help make sure that we have the right investment strategies to meet your needs. And then one more page. So as far as Texas is concerned, and this says Texas results, I think it's important to understand the commitment that we have to the state of Texas and the plans that we service in the state of Texas. We have 39 plans that we work with in Texas. Those vary. Those are DC, DB, governmental, hospital, corporate, all retirement plans in the state. We have about 475 public plans overall. That makes us the largest public plan consultant by number of plans in the country. We see a lot of things that affect plans, and as a governmental plan, it's a very dynamic situation as the environment for retirement plans changes in this country. We see a lot of things that happen from East Coast to West Coast, North to South. We're members of Texpers. We're also members of a lot of other organizations like Texpers, both nationally and locally, in CPERS, NASRA, and a lot of other places around the country. We have a Dallas office that we established in 2010. We have 3 Texas-based employees. And then one more page. Thank you very much. We're very proud of this. This is sort of a representative list of what our clients look like in the state of Texas. They won't all fit on here, obviously, but I think what you'll see is we're very familiar with Texas, and we work with a lot of different kinds of plans. I think a lot of people kind of gravitate towards this because in something that we're very proud of, like I said. But wanted to give you sort of a sample of what this is. What this means to you is I don't think you're going to find anybody that has more experience than we do dealing with plans like this in the state.
And Jack, I might just mention on this page again, very proud of this client list, honored that the Brazos River Authority logo is on this page. As you saw earlier, close to $100 billion in assets under advisement, a lot on the governmental side. So we are in tune with, the issues that impact public pension plans like yourselves, whether it's, dealing with new PRB guidelines or, new pension laws that might impact Brazos River Authority. We're very keenly focused on the Texas client. I think if you, again, look at where our success has been as a firm in terms of growing the business. Lots of new names to this page in the last 5 years. Irving, Texas, El Paso Police and Fire, $1 billion plus pension plan. Just a rebid with DFW Airport, close to $1 billion plan, DB, DC, and an OPEB trust. So again, very important page to us here at ANCO. So I'm going to go through some portfolio enhancements and some results over the last 5 years. But before doing that, let me pause there and see if there's any questions about anything that Jack covered related to ANCO as a firm.
I'm curious how many of your representative clients on this page have similar retirement plans to what the BRA has?
Yeah, great question. And when you say similar, are you asking in terms of size or in terms of being a public pension plan?
In terms of being a public pension plan, and the way that we have to allow people into our retirement plan.
Yeah, great question. So let's see, all of the fire plans on this page are public pension plans. So Orange, Texas, Wichita Falls, Harlingen, El Paso Police and Fire, Port Houston would be a great example. Public pension plan, but also similar to yours, closed to new employees. They closed that plan back in 2012. DFW public pension plan, also closed to most new employees. Tesser's public pension plan. Trinity River Authority is actually a 401A style plan. Irving, Texas is a supplemental benefit plan, and then Austin Police is a public pension plan. So quite a lot of these clients face similar issues, similar concerns to you all. Any other questions before we dive into the next page? If not, Mr. Thompson, would you page forward, please? Thank you. So one of the things we wanted to do is talk about some of the changes and the enhancements that we've made to the portfolio since we last rebid on the engagement. So I think one of the most impactful things that we did was introduce more passive investing. So we added a core equity index fund that Vanguard 500 index fund. So it actually represents our largest allocation of the portfolio now at roughly 30%. So an incredibly low cost way to access a diversified portfolio. We do think active management makes sense in places that are less efficient areas of the market. So, non-core fixed income, international equity, real estate. But really for our core holding, we have gone to an index approach with the Vanguard 500 fund. What that has done is significantly reduce the investment management fees by making that decision. Again, with that being really the core equity holding in your portfolio, that reduced the investment management fees from 0.77% to 0.47%. When you do that in dollar terms, when you equate that to dollar terms, that represents $70,000 in annual investment fee savings. So we think those are real savings. That's impactful. We think about that in number of benefit checks that represents, or capital that stays in the portfolio as opposed to going to investment managers that can be, reinvested and take advantage of compounding interest. So we think that's been hugely successful for the portfolio. We've made other enhancements. We've diversified the portfolio. We changed our international equity manager back in 2019. We moved assets to the American Funds Euro Pacific Fund, again, back in 2019. If we look at the results on that portfolio since inception, it's compounded at almost 22% a year. So that represents 10.5% better than the benchmark and outperformed 90% of the other international equity managers out there. So when Jack was talking about our research team, and reinvesting, profit in the firm, I think that's the fruits of the labor paying off there. We introduced private debt, so a direct lending vehicle. Interest rates are challenging for all pension plans. We've tried to be creative and thoughtful about that approach. The experience with that portfolio has been strong as well. In fact, it's been a key part of your overall domestic fixed income portfolio. And when we roll up all of the fixed income components and look at just how that area of your portfolio is done, over the last 5 years, it's ranked in the 5th percentile. And again, we think that is hugely important given how low interest rates are, right? We have an actuarial assumed rate of return that we have to hit year in, year out. With interest rates where they are, we have to be a little bit more creative. So I think it's a good opportunity to commend the retirement committee for considering that strategy. I know it was, a lot of due diligence that went into that, lots of good, tough questions, but ultimately it's been a very, very big success for the portfolio. We funded areas like GTAA. We've had good returns on that, which have helped us diversify the portfolio as well. Lots of income-oriented investments within those vehicles. So whether it's dividend-paying stocks, convertible bonds, high yields, again, trying to get as much out of the market as we can and capitalize on volatility where we can as well. Updated and revised the investment policy statement. So we did some work on the asset allocation and the latest iteration of the investment policy statement. I think that's resulted in some of the positive returns that we talked about. And we also, in that document, memorialized the rebalancing procedures. And you can see that's the next bullet point on this page. So on a monthly basis, we work with staff to look at the portfolio, look at cash flows, look at any outflow needs, and rebalance the portfolio. And that's been, again, a very nice feature. It's allowed us to do several things. I think one of the keys is risk reduction, right? It allows us to maintain a commitment to our strategic asset allocations. So, when equities run up like they were in 2018 and 2019, we were taking profits off the table, right? Stock prices were rising. We were using that as a source on a monthly basis to make benefit payments. The reverse of that was, pandemic comes in early 2020. Lots of fear in the marketplace, rightfully so. Equity prices are selling off. That was actually an opportunity for us to invest in a volatile market environment. So we were actually taking away from higher performing areas like fixed income. And it's that discipline that I think really leads to strong risk adjusted rates of return over time. It's cliche and sounds simple, but what it essentially does is forces you to buy low and sell high, and it takes the emotion out of the table. It makes it a more rigid, process-oriented procedure, and that's been again very beneficial to the plan. Next page, please. It looks like there's a question.
Yes, Tony, can you expand on the AA?
Absolutely. Yeah. Great question. So we funded that portfolio. Actually, it's two portfolios managed by BlackRock and JP Morgan. And they have a mix of equity and fixed income securities. We had used the MLP portfolio as a source to fund that, the GTA strategies, again, thinking that those were more diversified. There had been a decent amount of volatility in the MLP space. We like the yield out of the MLPs, but not necessarily the volatility that came with it. So the GTA strategies, again, more income focused, but they do have an equity component. When you kind of peel the onion back a little bit, tends to be about a 50% equity weighting to, or a 50% weighting to equity and 50% weighting to fixed income. But again, GTAA stands for Global Tactical Asset Allocation. So broadly diversified US and non-US, and it can shift amongst major asset classes. Does that answer that question?
Yes, and one other question, how do we manage overlapping investments?
Yeah, that's a good question. So we have a targeted allocation to GTAA of 10%, and we capture the equity exposure in that portfolio in our investment policy index and the fixed income exposure. So when we're tracking versus our benchmark, it considers the fact that that allocation is split between equity and fixed income. It's something that, again, as an approved strategy at ANCO, our analysts are having ongoing and recurring meetings with the managers that oversee those strategies to make sure that we have a good handle on the asset allocation, the underlying deployment of those assets, and that those managers are staying committed to their investment process, philosophy, and the strategy. So something that does occur kind of behind the scenes, but ultimately does get rolled up into the total portfolio and the benchmarks that we're tracking. Great question. Thank you.
Thank you.
So we talked about some of these enhancements and some of the changes, but I think what we're probably most interested in is has it worked? And I would say when you look at the portfolio's results, I think we would argue that yes, it has. Those changes, while not complete overhauls, they have been incremental changes, but have led to very strong both absolute and relative performance. So our number one goal for the portfolio and in the investment policy statement is to outperform the actuarial required rate of return of 6.5% for the 5-year period. So looking at the most recent results for your portfolio through 12/31, that goal was accomplished, and it was accomplished by a pretty comfortable margin, in our opinion, better than a 9% annualized rate of return. Again, net of those investment management fees. So going back to the work that we did to lower fees throughout the portfolio, that we recognize that hits the bottom line. So goal number one achieved. The 12/31/20 market value actually ended at an all-time high in the portfolio, just shy of $23.5 million. We took a look, went back to the 12/31/2015 report, kind of back around the time that we were rebidding on the engagement. And at the time, the portfolio was just below $20 million. So, despite some volatile market environments, including, this year, certainly that one won't be erased from memory anytime soon. You're looking at more than $3.5 million in investment gains, so both capital appreciation and income as well. Spoiler alert, looked at the portfolio through yesterday's close and we're at a new all-time high as well, $23.7 million. So again, off to a good start and ending the fiscal year strong. The 2020 annual return, better than 11.5% net of fees. Again, in the context of a global pandemic, certainly markets recovered strongly in the last quarter of the year. So we're not trying to take all the credit for that. But maintaining discipline, that strategic allocation that's in place, doing the appropriate rebalancing procedures really led to nice returns in 2020. Taking a step back and looking at 2019, I think that's a nice figure to look at as well. Portfolio was up almost 23.5% at that point in time, and outperformed 97% of the other public pension plans in the universe. And that's not just the universe that ANCO tracks. That's a third-party universe that includes pension plans across the U.S., certainly pension plans that have higher return assumptions, actuarial assumed rates of return. So, I think we would argue that your portfolio, very well diversified, has some nice conservative components to it. But even though we have a conservative tilt to the portfolio, which is appropriate for a closed pension plan, still able to capitalize on positive market returns. So again, kudos, I think, to the committee for making those incremental changes, being open to recommendations. So lastly, on this page, I mentioned the market value and where that stood. $3.5 million, nothing to overlook there in terms of investment gains. But again, I think it's important to think about the fact that over that time, close to $11 million in pension benefits have been made. So, at the end of the day, that's what gets Jack and I up and the rest of the firm up in the morning and go to work. This is truly, our passion, helping, people be in a good place for retirement, doing everything that we can to make sure that people have a safe, secure, and meaningful retirement. So we're pleased with those results. And again, thank you to you all. Looks like we might have another question. And that was really the last closing comments. And I know we're bumping up against our 20-minute prepared remarks there. So let me see what that question is and see if there's any more.
Yes, in going over the conveying portion of this, when we were looking at it, I thought that I saw that we had the 23,496,000 value as of now, but on January the 1st of 2020, I thought I saw 22,074,000. Was I mistaken on that? And which would only be about a 6% gain.
So I think the thing you have to consider, it's a good observation. Those market values, beginning and end market values, are correct. The other thing to consider, though, is over the course of the year, the plan would have paid out, and David, you probably have better numbers than I do, but I believe it close to $2.2 million in benefit payments, right? So we had cash flows out of the plan over the course of the year to make those benefit payments. So that doesn't get captured in that ending market value. So if you added that to the 23.5 million, it's a much higher number, but of course you have to make those benefit payments.
Okay, I'm just looking at the difference between the numbers are the 22 million basically, as opposed to the 23. But yeah. I'm not questioning your return there, but I just wondered where I would see different here. I was using the information I got out of Convene.
Yes, sir. Yep. Yeah. If we had started the year with $22 million and ended at $23.5 million like we did and paid no benefit payments, then that number is right. It would have been a 6.5% rate of return. Yeah. But the fact that $2.2 million went out of the plan to make those benefit payments, that's what that delta is. Yeah. Great observation.
Appreciate it.
Yes, sir.
What challenges do y'all see in the or benefits the change in the administration? What's it going to do to investment theory?
Jack, that sounds like a director level question if you want to take a stab first.
Yeah, thanks for that, Tony. So there's a couple of pieces to that, I think. From a pension standpoint, I think this administration is likely more pension friendly. We've seen there's a significant component, and I forget the name of the relief bill that was just passed, but there's a portion of that actually goes to fund underfunded pensions, predominantly in the Taft-Hartley space. So labor union pensions, and some of those are really significantly underfunded and don't have the same mechanisms to fund that pensions like this one do. So from that standpoint, I think the environment's a little more friendly for pensions. From an investment perspective, I think it's a little early to tell. There's certainly a lot of speculation now about interest rates. We've actually seen longer term rates rise. I think one of the things that is on a lot of people's mind, in addition to rising interest rates, is increases in taxes. I think we've certainly seen a lot of spending over the last couple of years, COVID-related spending. But I think with a more liberal administration, I think there's fears that there might be some additional spending that goes into that, and that gets paid for with taxes. Rising taxes is not generally the best environment for investment. So I think there's some headwinds out there from an investment perspective. In the short run, the rising interest rates ultimately will help bonds, which are really have very low yields and are a very challenging place to invest right now. So longer term, I think that helps them. Shorter term, I think there's some pain in that space if we start to see interest rates or continue to see interest rates rise like we have.
Thank you.
I think the only thing, if I could add one comment to that, and I think that's something we're keenly aware of, is the impact of interest rates. You know, we've been faced with this low interest rate environment. When we look at your portfolio, you know, as we, you know, hopefully if we're lucky enough to move forward with you all, you know, that's an area where we're going to do some additional work this year in the direct lending space. Again, your current manager, they're through their investment period. They're making distributions, so that area pays, you know, higher interest rates. It's in the private market, so you know, again, the rates are a little bit higher. There actually tends to be less volatility. It's not impacted as much on a day-to-day basis by moves in interest rates. So, you know, we think there's certainly some opportunities out there to be taken advantage of. But as Jack mentioned, some headwinds to be aware of as well.
No, but I don't want to scare anybody. The reality is that these are headwinds that have kind of been out there for a long time. Rising interest rates have been anticipated to rise really throughout my entire professional career, and we really haven't seen a lot of that. And you know, changes in the tax are kind of always something that's out there. I think when you look at your portfolio today compared to maybe what it would have looked like 20 years ago, I think it's very different. And the reason that it's different is because of some of these kind of challenges. Rising interest rates. How do you replace the historically, you know, 6+% that you were able to get out of fixed income? What do you do now? I think when you look at the portfolio, Tony mentioned private debt. I think you look at things like global tactical asset allocation. You look at things like real estate as things that are a diversifier for the portfolio, but also help to supplement some of the things that we've lost over the years as a result of some of the challenges that we faced. So it's not something that's new. It's not something that we anticipate necessarily being catastrophic in any way. I think it just creates, from our standpoint, a little more challenge because you can't just have the traditional 60-40 stock bond portfolio and expect to kind of get where it is that you want to get to.
Thank you.
All right, I think we're at our 30-minute here. So Jack or Tony, do you have few last words, wrap it up.
Yeah, absolutely. Thank you. Thank you for that. Page 13 shows our all-inclusive services. I think you know us, so everything that we provide. No additional fees for manager searches or travel or anything like that. I just in closing, thank you for the opportunity. Again, we're passionate about this business. We appreciate the partnership that we've had for a decade plus now. Thank you for the time today, and we would be honored to continue the relationship. So thank you all, and take care.
Yeah, I would echo Tony's comments. Appreciate the time, the opportunity, and the chance to be your consultant for the last decade or so. So thanks very much. We look forward to hopefully continuing to do that as we go forward.
All right. Thanks, Jack. Thanks, Tony. I appreciate it.
You bet. Thank you. We'll sign off now. Take care.
All right. Thanks. Bye-bye. I think we're running a little early here, but I did want to make a comment at the beginning. We will be ranking the firms 1, 2, and 3, and I just want to mention that we're evaluating the firms on qualification only, not on cost or price. So let's just see who else is out here. We've got. So I do not see the other firms out there. Let's take a break for probably about 5 or 10 minutes. It's okay.
Be back here at 10 to 10.
Perfect. Thank you.
All right.
Please let me know if you can see the slides.
Yep.
Alrighty.
Yes, sir.
I will turn it over to you, Greg.
All right. Well, I can't see anyone, so I'm gonna wing it here, and hopefully you can see me, and I hope Steve is on.
I'm on.
All right. So, and if you have any questions, please stop and feel free to ask them. By way of introduction, my name is Greg McNeely. I'm a vice chairman at Dayhab Associates. And we're going to present you our services for our consulting services today. So, Dave, if you could just flip to the next page. Tell you a little bit about Dayhab Associates. We were founded in January of 1986. So you do the math, that puts us, we'll be 35 years as of January of 2021. So a pretty long time to be in this business. We currently have 7 owners. We are 100% employee owned. We can go through those owners if you want, but we have 7 owners currently in the company. We are completely independent. We are not associated with any investment manager, any investment bank. We're not an actuary. We are not an OCIO. We don't have that business, and there are reasons for that, as far as not participating in the hot OCIO market. And that is, I think in order to go the OCIO way, you've got to lose some of your independence. And that's important to us. We are headquartered in Bayshore, New York, on Long Island. We've got field offices in Franklin, Massachusetts, where I am talking to you from today, Hollywood, Florida, and as well as Washington Crossing, Pennsylvania, outside of Philadelphia. We have 84 clients as of December, with aggregate assets of about $15 billion that we consult to, and I believe we have picked up another account. I don't know if we're signed up, but we can probably make that 84, going into 2021. I'm sorry, 85. Next page, please. So these are all the services that any good consultant should provide you. I want to talk about probably some of the important things, because everyone will do asset allocation studies. Everyone does performance reporting and evaluation. And you look down at this list, and you can probably see that investment management, due diligence, and research are a lot the same. But there's kind of a difference between due diligence, manager due diligence, and research. Manager due diligence is just that. It's doing searches for managers, making sure you have the best products, the best managers. Research can be a little bit different. I'll give you an example of some of the research that gets done. We always have clients that will come to us and say, hey, look, I read this, or I was talking to someone and we were speaking about this. So it all kind of plays into our client service, our education part, and we will research these issues that clients bring up to us. Next page, please. Talk to you a little bit about Dayhab Associates, and we're not the biggest consultant out there. We kind of have a regional focus, and you'll see that from our client list. But we have extensive experience in dealing with clients like Brazos River Authority. You look by type, most of our clients are public funds. That's our bread and butter. 70% of our clients are public funds, whether they be police, fire, or general employees or authorities like you guys. By size, 30% of our clients have assets under $50 million. I think if you look at our client list, and I think it's the very last page of the presentation, you look at our client list, many of them are $100 million, $200 million, but I will show you an example of one that we have picked that I picked up 30 years ago. at probably $15 million, and it's now in the $200 million range. So markets have certainly helped in that. Contributions have certainly helped in that. But having a client for 31, 32 years is also going to be a big part of that as well. Dahab Associates, we have 35 years of dealing with public funds. Next page, please. Talk a little bit about our consulting business. We average nine clients to one consultant. Some of us a little higher, some a little lower. We've got 13 consultants and research analysts. I think there's 7 consultants and 8 research analysts. Included in those are 8 CFAs and 7 MBAs. A couple of those people have both. That's why they are not additive. The average years of experience for consultants is 21 years. They range from Grant Carlson, who started in the pension industry as an actuary. Grant's got about 45 years. Of course, Rich Dahab and I probably have the next as far as experience, and with me being in this now almost 30 years. And the average years at Dahab Associates, it's kind of not normal to see this. Is our average consultant has been at Dahab Associates for 18 years. So Dahab is someplace that you may tend to retire from, and that's what I'm hoping to do. A long time from now. Next page, please. Page 5. Oh, we got to get off of this page. These are pictures, but just a little bit about the people who are presenting to you today. The important takeaway from this is not that my picture is not updated. That was done about 20 years ago when I was a lot less gray. So I apologize for that. But as you flip down to the next page, please, and I'll transfer it to Steve from here. We assign every client 2 consultants and a financial analyst. So Steve and I are 2 of our lead consultants at Dahab Associates, and every client gets 2 lead consultants assigned to it, not a senior consultant and a junior consultant. These are 2 people who have different backgrounds and can add a lot of value to what we give to our clients. You saw from Steve. Well, let me go with me first. I'll let Steve tell you about himself. I came up probably the old-fashioned way. Came through a business school, got a degree in business administration, focused on finance, and kind of went that route and started in consulting in 1988. Shortly after I graduated from college, and just kind of enjoyed what I did, enjoyed the clients, enjoyed the experience, and I've been doing it ever since. But again, that team approach, the diverse backgrounds of our consultants, and hopefully you read through our RFP response and you saw all of our consultants, but we all have different backgrounds. We've got Dave Lee has a degree in in biotech, so he came out of that industry. Steve, what were you again, Steve? Geology?
Well, yeah, before graduate school, I was actually a geologist. I studied undergraduate geology. I was a hydrogeologist. I was working as a consultant for a small environmental firm here. We were working with Exxon to help mitigate pollution from underground storage tanks and gasoline stations.
Yeah. So the important takeaway in looking at our pictures and looking at our consulting model is we offer different perspectives from the consultants that are assigned to you, from our consultants in Dahab Associates. One of the important takeaways from me is the fact that I'm a smart person. I married a Texan that graduated from Stephen F. Austin. So, and my in-laws live in Grapevine, so I've certainly spent some time there in Waco over the years. And Steve, with that, I'll pass it on to you.
Excellent. So a little bit more about myself. I'm the Chief Investment Officer and Consultant for Dahab Associates. I was a hydrogeologist for about 5 years, went back to school, got my master's, and I've been in research ever since. I've always been a researcher, even, undergraduate, researching rocks. Once I came out of graduate school, I was a researcher for stocks. I worked on the buy side, covering a lot of equity names, mostly technology. But so I worked for a lot of money managers, similar to the ones you employ here. Say about, I don't know, 2007, I kind of got tired of the long commute into Manhattan and the long hours. So looked for something different. I came on to Dave Associates and started out in research here and worked my way up. It's a little bit about me. Let me talk a little bit about just our philosophy. So if you want to turn to the next slide. And really our philosophy in a nutshell, it's really protection on the downside. We've started a lot of our conversations. We always focus on what can go wrong. What can go right? The upside generally takes care of itself over the long run. Equities itself, if you look at large cap, the S&P 500 has returned annualized 7 to 10% every year. Mid cap a little more, small cap a little more. So the upside typically takes care of itself as long as you focus on the downside. And when we're looking on the downside, it's really permanent loss of capital. That's sort of what we want to avoid at all costs. From an investment side, philosophy is what we like. We follow the keep it simple approach, keep it simple, stupid approach on investing wise. We like equities. Your portfolio's got plenty of equities, long only equities. That's sort of what we like. We take a lot of volatility risk, but we understand that volatility risk. You rebalance into it like we did in March of 2020. We like investment grade fixed income, core fixed income. It offers great stability. You could use March 2020, the first quarter 2020, as a good litmus test of what you have in your portfolio. If it's a safe asset, it was probably up that quarter. If it was a risky asset, it was probably down that quarter. That's sort of how we view the world. So next slide, please. What we don't like is just complexity. We always feel like complexity typically benefits the seller. Being a public entity, long-term returns matter. So we don't want to pay up for expensive strategies that sort of mitigate volatility. We'll accept volatility. It's a risk we prefer to take sometimes. And it's a cheap risk, and it's a risk we understand. We don't like a lot of products that other firms sort of will bring to the table. And, if you do hire us, you probably won't see us talking a lot about hedge funds or any of these, engineered products. These come out every 18 months. There's always another new product where Wall Street sort of sells into the fear. We see these things come and go all the time. And so we typically just stay on the sidelines. We watch them. We'll let them play out for a full cycle before we get kind of comfortable at, recommending them or putting them in our client's portfolio. Because we want to focus on the downside. What can go wrong with these things? A lot of times they're new. You just don't know what can go wrong. Fixed income with hidden equity risk. Now, this is important to us because that's really an area where you could experience that permanent loss of capital, especially in fixed income, because if, a company goes bankrupt, they go bankrupt. You might get, some dollars, some cents on the dollar on your fixed income investment, but you have a big chance of losing money there. And so we typically tend to stay away from these things. Again, a good litmus test, if you've got fixed income with hidden equity risk, how did your fixed income investments do in the first quarter of 2020? If it was down, you might have a little bit of risk there. What helped out this year was the Fed came in with lightning speed. We've never seen this before, and bailed everybody out. So that was good, but you just don't know if that's going to happen again. So that's, a concern for us. And leverage cuts both ways. Again, with the downside focus, we're always concerned about leverage killing us on the downside. So we tend to stay away from excess use of leverage. Now, if you turn to the next slide, this is how it sort of worked for us in the long run. So this is one of our clients. It's a different client than Greg was referencing. This is actually one of my clients. It's a small municipality in central Virginia. It's a police and fire plan. We've had them since 1986. Basic portfolio, long only equity, large cap, no small cap, but large cap, mid cap, core fixed income. They have a couple of other things in there that you all don't have, timber and core real estate. But over the long run, it's worked. So if you look at the bottom of the page here, they've returned annualized net of fees 8.3%. So over this entire time period, year in and year out, they've returned 8.3% annualized net of fees. Now, there's been bumps in the road. That's the volatility risk we take, but we tend to rebalance into that. We kind of enjoy those periods of time. Those are sort of fat pitches for us. A good way to view the chart is this sort of solid line at the top of the chart. That's the actual experience net of all fees and expenses of the plan in dollar terms. That first sort of dotted line, that's sort of trending off towards the end of 2017, 16. That's the actuary rate of return. So they have a 7% actuary rate of return, required rate of return. Since the plan is overfunded, we're about 117% funded now. We've been compounding on that. So that's why you're starting to see that sort of required rate of return dropping a little bit. Now, they've raised benefits, in the interim since we've done this, but we've still been able to, well, the markets have been kind to us. So we've been able to rebalance at opportune times and take advantage of the market. And so the portfolio still returns ahead of expectations. And then that last sort of dotted line, that's the cash flow line. So that assumes no return. And so what's interesting about this is this plan has been a negative cash flow situation for quite some time. If we didn't return anything, it would have actually ran out of money in 2005. But, it's returned some, and the city has been somewhat responsible, not fully meeting the required contribution all the time, but 75, 80% of it year in, year out. So this is just an example over the long term how the markets work, how, don't worry so much about the upside, because in the upside it works in the long run. If you want to move to the next slide, this is just sort of short to intermediate term. So this is actually the average performance of all of our public clients over a 1 to 10 year basis. And this is ending December 31st, 2020. And as you can see across the top line, we've had fairly solid returns for our clients. And this is every public client we have. The line right below that is our universe ranking. And so that's just, we submit to an independent service provider called Investmetrics. It's us and a consortium of other consultants. And then they just supply us with the rankings once everybody submits it. So you're probably familiar with rankings. 1 is better, 100 is worse, the scale 1 to 100. So for the 10-year and 7-year, 15th percentile, that means our plans on average, for every public plan, has returned better than 85% of the other public funds out there in the universe. Below that, we have our netter fee returns. And interestingly enough, the netter fee returns are still beating the average median plan over the long term by 50 basis points, by 0.5%. That's because we do focus on fees. If you follow the keep it simple, stupid approach and keep your equity in plain vanilla, you save a lot on fees. If you avoid the 2 and 20s, a lot of the hedge funds, a lot of these really, go sort of strategies, those tend to be expensive. Again, complexity benefits the seller, and those tend to be a little bit more expensive. If you turn to the next slide, this is just your portfolio as of September 30th, and we're familiar with everyone here. Nothing wacky. We see some portfolios that you kind of cringe, like, whoa, what are they doing? But no, everything here is, standard stuff. We know everybody here. So next slide, we'll just slice it up a little bit more. And again, nothing too crazy here. One thing I want to point out, though, so on the upper left is sort of the pie chart of your allocation. The one thing we noticed a little bit is your fixed income. You've got a 29% roughly portfolio allocation. That's sort of looking into also the balance, the GTA plans. But if you look at it sort of from a risk versus safety standpoint, so when we talk about risk versus safety, and I like to keep everything simple for myself. So a risk asset is anything that could be down 20% in a quarter. Go back to that first quarter of 2020. If it was down, say, 10 to 20% in that quarter, it's a risk asset. A safety asset is something's going to protect you during those periods. So go back to that first quarter again. If it was up in the first quarter of 2020, that's probably a safety asset. And so that's sort of the way we view the world. We want to always kind of cut through sort of the Wall Street monikers and figure out what's going to save us in a tough market, what's going to earn us returns over the long run. So a risk versus safety asset. And so relative to the rest of the universe, you're kind of a little bit more safer than a lot, a little bit more aggressive than others. We see safety assets roughly in the 30 percentile range. You guys are a little bit below because you do have a little bit of below investment grade in your fixed income bucket. But that's where everything is in terms of active versus passive and foreign versus domestic, all sort of in line with industry norms and what we kind of see across the board. The next slide, slide 13, it's just some of our initial thoughts. And it's tough from our perspective to give these because, it's sort of a 10,000-foot view, but we don't know. The sort of environment that you all have. We don't know your cash flow requirements. We don't know your liquidity. We don't know the political regimes or the risk tolerances of the boards, of the board. So this is just sort of, to help give you an idea of what we would probably suggest through conversations with you. This would obviously change, but what we'd suggest. And to really take a step back, if you want to think about asset allocation, there's really no right answer. There's no one asset allocation that's the right answer. You can think of it more of sort of like your GPS on your phone. You know, you're in one spot, I'm in my driveway, my house, I plug in an address, it gives me 3 different ways to get there, all within 1 minute. That's really what asset allocation is. You know, there's multiple ways to get there, plus and minus a couple of minutes, depending on a traffic light. But these are just some of our thoughts to hopefully give you an idea of what we're sort of thinking. So the first part is just overlapping asset classes. You'll have a SMID cap manager and a mid cap manager, and they tend to overlap a little bit. One's passive, one's active. So if you think about your active guy, if he's got most of the stocks that are in the passive ones, you're kind of paying a little bit of extra for, you know, passive management. It may make sense to either move your mid cap allocation to small cap, or maybe bring your mid cap allocation to your SMID cap. So you'd have a large cap and a SMID cap. That would take the entire cap range. Right now, you're just sort of missing on the small cap side. Another one would be potentially introduce new asset classes. Like I said, small cap, one exposure. You have the Euro Pacific Fund, very good fund. It's got emerging markets in there, but maybe a thought of, you know, potentially including an emerging market manager, because emerging markets is you know, sort of fairly big in the investment world. It's about 25% of the global market cap, 25% of the investable universe, and it's about 20% of the population of the world. So, you know, maybe something to think about. One is the GTA, another one. I know you all just recently hired it, and I'm not trying to poo-poo it. The one thing we always look at with GTAA and any of these, you know, so-called experts that you pay to, you know, time the market, if the allocation is not beating your portfolio, then why have it and pay the extra money for these experts? You know, if you look at your 2 GTA managers, and it's been only a short time, but for the past year, they haven't beat your overall portfolio. So, you know, what you're doing is probably a little better than what they're doing, and it's probably cheaper. So, you know, that's just another thought to sort of, you know, think about a place to reduce fees, reduce a little bit of complexity. Because a lot of times with these GTA allocations, you're really not sure what they're investing in. So, you know, risks can be hidden somewhere. In your fixed income portfolio, I talked about a little bit of high yield there, a little bit below investment grade. Where we are today in this economic cycle, which just was reset this year, but fixed income's kind of expensive. You think equities are expensive. Fixed income's really expensive based on historical norms. And so you might want to think about, again, with the thought of protecting permanent loss of capital, protecting against that, maybe, you know, it's prudent to reduce a little risk here. High yield and low investment grade has had a hell of a run. So maybe, you know, sell it when it's high. And, you know, think about it, you know, the next time there's another recession. And then you all don't have core real estate. You've got a REIT, which is really equity. It's sort of a risk bucket. And you have an opportunistic manager, which is sort of a risk bucket as well. So core real estate is a conservative real estate. It's a little closed end. So, I mean, it's open end, but you're going to reduce a little liquidity relative to your Cohen and Steers. But over the long run, they do produce a nice, modest return with relatively low volatility. So it's a good sort of fixed income surrogate. There's going to be some down years, but over the past 40 years, there's been 4 down years. Even this year, the core real estate is up for 2020. So that's just another thought that, you know, we could introduce into the portfolio, maybe take away some of the potential permanent loss of capital in the high yield fixed income, and increase get some return back from core real estate. So those are just our thoughts on the portfolio. Next slide. I think I'll just turn it back over to Greg to finish it up.
All right. So if you move to the next slide, again, just to kind of wrap it up, you know, our process, if you were to hire us, you know, the first part is just kind of review what you have. Our purpose is not to come in and redesign the wheel, so to speak. So, you know, review your investment policy. Well, make sure you have an investment policy. Review your policy, and you know, just, you know, collect the documents that we need in order to go through this process. We gather 5 months of bank statements. We recalculate performance. We don't just take what has been produced by your previous provider. And we have, believe it or not, we have caught differences in performance versus what other consultants have produced over the years. Mm-hmm. We're going to review your fee structure, make sure that you are getting the best fees possible. I know you guys have the Euro Pacific Growth Fund. You're in a pretty decent share class for Euro Pacific Growth Fund. Just as an example, I took over a client a number of years ago and reduced the. They had the very same fund, but they were in a series that they were paying like 179 basis points. And we were able to reduce that fee tremendously and have the same exact product. So just make sure you have the right fees for the right products. And then the last step, after we go through all those procedures, we will sit and we will discuss the allocation, talk about different asset classes. Again, the education part, the research part of what we do is really to get that and relay that information onto our clients. So we discuss the allocation, discuss asset classes, discuss if you want to make a change. And again, it's our job at that point in time to educate you and put together the best portfolio possible at the lowest possible fee. Next slide.
Yeah, to add that, we'll never come to you and say, invest in this today. Everything will be education. What are you comfortable with? Do these risks work for you all? Because going back to that GPS, there's no right answer. There's a lot of right answers. So we want to make sure that you all as a board are comfortable with what you're investing in and know sort of what you're investing in as well.
Next page, please. So again, just to kind of wrap up, we've talked about all these different bullet points. Why Dahab Associates, and the first bullet point, like I said, it's you're the right size for Dahab Associates. We are the right size for you. So we have clients. We've had clients in the past. You're kind of our bread and butter. When you look at the clients that we service. We talked about our highly qualified, experienced consultants. This industry is, when you look at the consulting industry, I think it's kind of rare to have consultants that have been doing this for as long as some of us have. Quite frankly, what happens is after 15 years or so, consultants will get a lot of offers from money managers to come and work with them and make more money and go to the dark side, as we call it. I think we are all here at Dahab Associates because we like doing what we do. The hardest part for me in this whole pandemic is I don't get to see my clients. I don't get to sit and have discussions with them. I've got 19 clients and for the most part, I know their wives, I know their kids, and we've kind of grown up together. So I miss that kind of part, or that part of this job. Easy to understand reports. Again, they aren't in this presentation, but if you had a chance to look through our performance report parts, they're easy. They're programmed in-house. We can make changes to reports. If you want to see a certain kind of information or things presented in a certain way, we have the ability to change our report. It's not a canned report. We don't buy it from someone else and stick in our numbers. These are our reports that we have designed over time, and there's 35 years worth of improvements in these reports as you look forward. Probably the most important, right in the middle of the page, no conflict of interest and full transparency. We have no other source of revenues other than from our consulting clients, and they are all hard dollar fees. So we don't collect finder's fees from management products. We don't have products that we can put into your portfolio and make and augment our returns, and we don't do brokerage. We have absolutely no conflict of interest. Skip over the fee part. Hopefully you talk to references. I think we gave you 5. If you look at the very last page, we're going to skip over 16 because we talk about fees, and I don't think you guys wanted to discuss fees. So if you go to page 17, the last page of the presentation. That's a representative list of our public fund clients. You can see they range from New England all the way down to Alabama, Kansas, Tennessee, Missouri, Florida. So you can see we've over the years developed a regional focus, and that's really based on where our offices have been, and where the states are set up for public funds. So, Massachusetts has 106 systems in Massachusetts. There's 400 and some in Florida. So that's why you see an amount there. You look at Virginia, I think there's 8 public funds you can get to, and we certainly have our share of Virginia accounts, probably more than half of them that are available. So, those are our public funds. The one I mentioned at the very beginning, town of Shrewsbury, Massachusetts, was my very first client that I presented to myself back in 1989. So they had been with me for the better part of my career as a consultant, and one of my longest standing clients, and they're still a client today. And like I said, they just pushed over $200 million from an account that I picked up in '89 that was $15 million.
Okay, we could just got a few minutes here for a couple of questions, so I'll open it up for questions here.
I have a question. What do y'all see changing in the investment world going forward with a more liberal administration?
That's still up in the air. Well, I could take it from a market perspective. Right now, what the markets are concerned about is taxes. What's the corporate tax rate going to be? What are the loopholes going to be? Right now, the market's really not believing in the infrastructure bill the way it's being presented. It feels that it probably will not pass. And it's also not believing that the increased taxes from that infrastructure bill will pass. But who's to say? That's what we're seeing coming from the equity markets.
The best defense I think the general consensus is right now it's unknown, and the best defense for that is to make sure, and we do this with most of our clients, make sure you're properly diversified, make sure you don't put all your eggs in one basket, and the second thing is we try to put together high quality portfolios. And by high quality portfolios, for the most part, they tend to outperform down markets and keep up with up markets. And over time, you tend to outperform. And that kind of plays out when you look at that long-term performance that Steve showed you. We tend to do pretty well during full market cycles, just because we conserve when the market goes down, we don't go down as far as the rest of the market.
Yeah, so we're positioning now because there is uncertainty with this agenda, right? It's not pro-business anymore. It's pro-spreading the wealth, and you can see that in the narrative coming out of Washington. So right now with our client base, we're pretty much keeping our safety assets at target because you just don't know what's going to come out of left field right now.
Yeah, and specifically, we're trimming equities and putting it elsewhere. Mm-hmm. For the most part, taking some of the gains over the last number of years, even the last quarter, the last couple of quarters, going back to March of 2000 or 2020, taking those gains and sending them elsewhere. So again, might be a little on the conservative side, trimming now and reinvesting in other places. But that's what the discipline does for us.
Any other questions? Okay, we appreciate it, Greg and Stephen, on your presentation, and we'll get back with you later here. Okay.
I appreciate it, Dave, and thank you all, and go Baylor. I got them as my winner in my Final Four pool. So.
Okay. All right.
Thank you for the time.
All right.
Thanks, guys.
How are we doing on time, David?
We're doing good. I asked the next firm to join at 10:30 so that we don't have space for 15 minutes. So they should be joining here in a couple minutes.
All right. So see everybody back at 10:30, right?
10:30, sounds good.
Thirty, folks, we're back in session.
Director Luton, we have two more. I think you have two more coming on, Tom. Is that correct?
That's correct. Ted Grigsby, he'd be the consultant, and then Ned Taylor, he'd be the proposed co-consultant. And it's correct, it's a half hour for the full presentation?
Yes, 20 minutes presentation and 10 minutes of questions, or you can have questions during the session.
Terrific.
We're running a little early, so I gave everybody else an extra 5 minutes, so we have 35 minutes.
Terrific.
There's Ned.
Good morning.
Good morning. All right, all right, so we've got everyone here. Let me share my screen and you can just walk me through the pages here. And you see my screen?
Yes.
All right, I'll turn it over to you.
I can see it, yeah.
Okay. Just let me.
Ted, you want to, you might be on mute, but you want to dive in?
Yeah, sorry, I was on mute there. Can you guys hear me okay?
Yep.
Okay, thank you. Great to meet everybody here. Just on behalf of our firm, first of all, we're thankful for this opportunity and excited to potentially serve the Brazos River Authority. I know that we have a pretty tight sort of agenda here, so we can just I'll just do introductions and then we can kind of dive right in. I would serve, if we were selected as Brazos River Authority's consultant, I would serve as your lead consultant. What that means is my responsibility would be to coordinate and lead the efforts of our firm on behalf of Brazos River Authority. And I do that for other organizations similar to Brazos, cities, counties, government organizations, and also nonprofit organizations as well. Ned Taylor is on the call. He would be assigned the co-consultant. For us, it's important for every single client we have, whether small, medium, or large, it's important for us to assign 2 consultants. And there's clearly a benefit of coverage. If one of the consultants can't make it, the other can seamlessly pick up and really kind of take things from there. But the other value that we've seen come to our clients through that is not just in coverage, but it's in the idea sharing and having a second set of eyes and second brain and thoughts and ideas and perspectives in serving our clients. And the folks on our team, and we'll share a little bit more about that, we have folks that come from a lot of different areas in the financial services industry and a lot of great perspectives. So in a lot of ways, we're a think tank on behalf of our clients, and we try to create and build that scenario for each and every one of the clients that we serve today. Tom, very similar, leads our analytics and research efforts at our firm is a huge component and driver of the intellectual service that we provide to our clients. And Tom just had a baby, and so if he starts nodding off or falling asleep in the middle of our discussion, there's a good reason for it. But we'll all have an opportunity to share today. But just a quick introduction on our firm. So feel free to move ahead there, David. Okay, just a quick overview. I know we have about 20 minutes and we're 3 or 4 minutes into it, so we'll kind of move forward here. I'll do a brief introduction. We want to spend time on the methodology and evaluation approach. We think, at least in the time that we have here, we want to provide as much insight we can as to how we might serve the Brazos River Authority. Particularly, we've set aside some observations that we thought we would share based on the information we received. We think that this is important in a discussion like this because outside of us just telling you what we do, it gives you an opportunity to see our line of thinking, how we approach things, and maybe engage in that way, in that manner. Knowing full disclosure that we have a lot to learn about your plan, we have a lot to learn about your organization, and so I think it's just a good starting point. We'll touch on transition. If we have time, we'll run through some of our reporting samples so you guys can kind of see what that would look like, some of those deliverables, and go from there. Feel free to go ahead to one more, David, if that's okay. So quick introduction, our firm, we were established about 13 years ago, right in the teeth of a financial crisis, a great time to start a consulting firm. But we were started by our founders with the sole purpose of serving as a fiduciary for institutions and organizations. And that's it. So every resource in our firm to serve that end, to serve those clients in that regard. So to not have any competing services such as wealth management or benefits consulting or those things that constrain resources. Certainly over the course of 13 years, we've held true to that, and that's been a huge driver, I think, in why we've been able to add a significant amount of value to our clients at a high level throughout that period of time. We don't have competing services, and this is our sole line of business. We're an SEC registered investment advisor. We sign on as a fiduciary for every single client that we serve. We have that as a standard of care and obligation, basically meaning that every piece of advice that we provide in service has to be in the best interest of the client and not ours. We cannot have any conflicts of interest. We have a transparent relationship, and so we've desired to set our firm up that way and to continue to serve that way because we can sit on your side of the table, and any advice that we give is from your perspective. Go ahead to the next page, David. Over the last 13 years or so, we've experienced a fair amount of growth. I think we're nearing around 40 billion in assets now, about 156, 160 clients or so that we serve. We think that this growth has happened largely because of what I mentioned before, our singular focus in what we do. I think we've been able to provide a value, and that's driven the growth that we have. So while we compete with some of the larger firms in the nation, we're pretty small and mighty. We have about 21 folks on our team. We're based in the Northwest here, but our client base extends throughout the country. And we do a lot of work in Texas, and we spend a lot of time down there. So this discussion today, we're really excited to have this and continue to go through this here. So thank you. David, feel free to go to the next page. We serve clients of all size, small, mid, large, defined benefit, defined contribution, primarily government. We have some coverage in ERISA plans as well, some nonprofit organizations as well. David, can you go to the next slide? And if you were to spend time reading through our client list, you'd see a mix of cities, counties, districts, authorities, corporations, a broad mix of a lot of different clients. A lot of them are your neighbors and kind of right around your area there. San Jacinto, River Authority, we recently engaged with them. City of Dallas recently became a client. And Ned, you serve San Antonio Water Authority or Water
Right.
Services.
Yep. So I work with SAW down there in San Antonio, and it's I think we're at 8 or 9 Texas plans now. I think, the experience we have now working with San Jacinto and SAW is, we have experience working with pension plans that aren't subject to the Texas Pension Review Board. We're familiar with the Texas Pension Review Board, and so to see your plan, we have a lot more flexibility working with a plan like yours, with the freedom of not being tied to the insurance companies like we do in some of the others that are trying to kind of avoid that oversight from the Pension Review Board. So excited to potentially dig in with you guys and help you move that plan forward.
Go ahead and jump to the next page, David. So just a visual outline of the dedicated team that we have assigned to you outside of our firm, although a bit of a caveat that we all pull on the same rope. We all work on behalf of each and every one of our clients, and so it's likely that there would be more folks in this involved. We've got a great organization. The strength of our firm that, internally we say this a lot, is our ability to collaborate and our respect for each other. And I know that that's probably a common thing that's said, but it really is, as I kind of pointed out earlier about us being a think tank for our client, is how we approach our firm and each other. One of the sort of quantifiable metrics of that we're proud of is that since the inception of our firm, we have not lost a consultant, an analyst, key administrator, and so our firm has more or less been intact since its foundation 8 or 13 or so years ago. And I think that speaks volumes to our respect and work together. But the thing that there's a huge consistency in that for our clients, and there's not a loss of institutional knowledge. We continue to grow and get better and better. So as much as we can share how great we love our team and everything, that's a key metric we always like to point out.
And I would add that this is Ned. I would add everybody you see, everybody you meet with in terms of finals, they've made it. They've given you a good response. You're going to see an org chart. I would say that everybody on this page that you're looking at now would work on your plan, and everybody at our firm, we're at the size that everybody at the firm would know you're a client. And we're a growing organization, and it's we celebrate every win we have. The last thing I'd say on the team before we go into the approach is that Ted mentioned, we only do one thing, and so there's no competition for resources. It's also why we've had such a successful run in terms of keeping people. People come to the firm because they know what they want to do with their career, and they don't want to work on individual private wealth. They don't want to work on benefits. They want to work on institutional investment consulting. And so we have, you see, just looking at some of the names there, the experience, we have people that are doing what they want to be doing. And so we don't take that for granted. We also value relationships, and we don't expect to change relationships. You see Ted as the lead consultant, and you'd be working with Ted. Ted's expecting his third. He's not going anywhere anytime soon. So should we be fortunate enough to work with you, Ted's probably looking to have that relationship be at least 20 years. So that's just who we are. Hopefully that speaks a little bit to our culture. I'll go through, David, if you want to move ahead 2 slides, I'll go through our approach. We start every pension plan with an asset allocation study. We work with you to review your goals. I'm going to go through the next few slides and start at the 30,000 foot level. You'll see on here there's some specific things that we know about you. We've spent some time on the Pension Review Board site, spent some time with the information you've given us. And I know Tom, who you'll hear from next, he reads CAFRs in his sleep, so he loves digging into those. So he'll get into some of that. But you can see we start with the big picture. What are some of your goals? We help to identify those. We quantify those. We look at what all of those are. You see the unique circumstances, the last item on the chart on the right-hand side. We know the plan's been frozen since 2007 and it's 64% funded. So from that, we can help build a better mousetrap. Dave, if you want to go to the next slide. From there, we look at what asset classes can meet those objectives. So you can see in the upper right, all those asset classes laid out in terms of risk and return. We try to build a model that can look at those and what combination of those. We put constraints on those so that we're not investing too heavily in any one area. We customize that portfolio. We develop our own capital market assumptions internally that we use. We work with your actuary to talk about expected return. Sometimes we push those actuaries a little bit. They'd always like to dial that expected return down, but we can show them, because we're building these models, we can show them our confidence level. And from that, once we've identified objectives and identified the applicable asset classes, if you want to go to the next slide, we can model different portfolios. So you can see we've put your current portfolio in there on the right-hand side, and then we've modeled 3 different asset allocations getting to the expected rate of return, and that's a net rate of return, and then also expected risk with those returns, so that we can dial in the right amount of return to get you what you need for the funding and the valuation, but also not taking extra risk where we need to. From that point, if you want to go to the next slide, we can test that portfolio, and we can show, based on this level of risk and return, let's stress test that portfolio and say if we had larger than expected outflows, we can model that. And if we had different rates of return, we can model, your kind of the wide part of the bell curve and what happens if we have an event where we're underperforming. So you can see some examples there on the page on the right-hand side, especially where we've shown what that looks like. So go to the next slide, David. We can show you just one example, and this is we have a saying in our office: every basis point matters. But this is kind of the boring stuff, getting into the weeds. But if there are areas that we can, and we found for a plan your size, cost control is a huge variable, that even saving a few basis points, that translates directly to return. And over time, that adds up. So over the length of a portfolio such as yours, you can see just by making a few tweaks. And so we've got a couple examples up on the top right-hand side where just by changing share class, you can see what that does to the expense ratio in the top chart, and then what that translates to in terms of 5-year return. And then over the course of a 25, 30-year run, what that does to expenses and what that means to added dollars in the plan. So that's just one example of things that we look at, and we found just dialing in that cost to the lowest possible share class in many cases can have a huge impact. Go to the next slide, David. I see we're getting close to time, so I'll turn it back over to Ted.
Yep, I'll go through this and we can move to our observations. We spend a lot of time with our clients on governance, and I think, as Ned pointed out, the every basis point matters That really comes from the headwaters of that is establishing good process and good policy. And we believe that strong results, strong returns are a symptom of good process. And so focusing on establishing an investment policy statement, all of those various governance documents and items are crucial to the long-term decision-making of a committee and our involvement. The day that we sign on with our clients, the day that we sign the contract, we're a fiduciary, and we start thinking about all of those things that are going to lead to good governance. And those are on us, and it's incumbent on us to address those. So how that works out is typically throughout the meetings, throughout the course of the year, the quarterly meetings, we would look to review or address the investment policy statement, if there was a fee policy, governance other various governance documents that you might have, provide fiduciary education. We would look to sort of integrate that throughout the course of our relationship on a quarterly basis. Go ahead to the next slide, David. And Tom, did you want to cover?
Yes, thank you. In the interest of time, I'll be brief. And actually, if you wouldn't mind, David, please skipping ahead to slide 18. Thank you. The preceding two slides gave an overview on our fund selection process, which I'll just verbally summarize. As we're all in-house, we're all experienced, we've all worked together for many years. We do all our fund research in-house. We don't take advice or rely on the advice of external providers. And that process has been in place to what we think to be our client satisfaction for many years. This next table, thinking about your plan on many levels, gives kind of a summary of how we think about structuring a pension plan, and starting from the high level to the bottom level. I won't cover everything on this table in the interest of time, but I will say that it's reflective of our process is if we want to, as we design a pension plan's asset allocation, we think about it in terms of asset allocation, that is the mix of various categories of stocks, bonds, and alts. And then on the next level, what's called the intra-asset class allocation, which is how we construct the particular asset allocation of a stock category or a bond category. Then, as you go to the far right column, you see the funds. That's basically fund selection within that category. And then the step after that, which is shown on the following table, is expense ratio, picking the lowest cost expense ratio share class, all else held equal. One brief observation we'll make, which we draw from your 930 performance report, thank you for sharing that with us, is look at, I'll start at the U.S. stock allocation. For example, as an example of our thought process, as you see, if you go to the intersection of where it says U.S. and then asset allocation kind of in the top middle, we find that your pension has what we think to be a high allocation, an above average allocation to U.S. large cap stock. That's something that we think we would, if we were your advisor, we would seek to diversify away as smaller and mid-sized stock categories have higher expected returns, and also to increase diversification. Within, and moving to the far right, if you see the funds that we've selected, we looked at the funds that you have used to represent that asset class, and some things that come to mind that we might structure differently are in the selection of underlying funds. For example, the Vanguard 500 Index Fund and Mid-Cap Index Fund, about 75% of those index funds overlap, meaning that you're buying the same fund twice, if you will, which in our mind is not an efficient way to construct a portfolio. Also within that category, we see that your one active fund does have a tilt towards the value investment style, which is fine, so long as, in our minds, is it's paired with a growth investment style and doesn't cause a pension to lag in this particular category when one style is in favor of another. That's one look. I hope you find it representative of how we construct a pension plan on an asset class and a fund level. If you could please go to the next slide. The last step that we take, which is in some ways a surprisingly important step, is simply the detail work of finding the least expensive share class so that our clients don't wind up overpaying. So again, if you look at the U.S. asset class, we've looked at the funds that are offered and compared that to what we see to be available in the marketplace for the exact same fund. We find that there are a couple of examples of a cheaper option, and the annual cost savings on the right is given. Not something that's going to put the fund at fully funded ratio next year, but something that may be equivalent to a participant's monthly income payment from the trust. So that's a quick summary of our thought process. I'll leave the rest for your perusal if it's of interest. And if you could skip ahead to slide 21, please. I'll hand it back to Ned to talk about a transition approach.
Perfect. Thanks, Tom. We'll wrap it up. Basically, you see an outline of our engagement and what we would do in terms of if we were to be fortunate enough to work with you. We've worked with Wells Fargo. Wells Fargo is actually the custodian on SAW's retiree health savings plan. So we worked with the team in Texas. I work with another pension plan in Alaska, and they use the service team for Wells Fargo in Texas. So we're familiar with that team. We're familiar with working with all the different parties, and it would be a seamless transition for us to step in.
And I'll add to Ned's point that our approach as a team is to take on as much as we can on behalf of our clients, and so we're really working with you, but more driving the ship if that's something that is of benefit to our clients, and will really lead this process of transition. If we have enough time, David, I'll kind of ask you here, would it be helpful to run through the various reports that we have? Or I know we're about 24 minutes now, so I want to be respectful of the time slot that you guys have allotted and allowing time for discussion and questions and whatnot.
Yeah, we were a little over for some of the other ones. So you have about 8 minutes, 8 to 9 minutes.
8 or 9 minutes? Okay, great. Well, I'll just maybe if we go to slide 23, I can just give you a quick overview of our reports. And again, we've just pulled out a couple representative reports. In every quarterly meeting or every plan review that we do, we're always going to provide global macro themes and what's going on and how is that playing out in the various securities markets, whether it be U.S. international stocks or the fixed income markets as well. If you can go to the next page.
I do want to mention that those 8 minutes, you got to save some room for questions too.
Yeah. Okay. Well, then we can sort of wrap up here. Our reports generally are set up customizable. We build them all in house, and they're set up to view the portfolio from many different perspectives, as well as external drivers, as I kind of point out here, and then really measuring the portfolio against policy, performing against its peer groups. And if you guys want to take time to review our reports, and if you would like more samples, then we're happy to send that as well. Just let us know. Can you go to the very last page, David? And again, you guys have the opportunity to review our reports and have this on hand there. So we just want to end with our commitment to the clients that we serve. Every client that we sign a contract with, we put dollars at risk in the event that we don't live up to the expectation of our clients. And we've never never been called on this at all. It's never been something we've had to use, but it's a commitment that we make, and it's something that just is a token of showing how much we value our clients, how much focus and attention we provide each and every one of our clients. So we would certainly, with Brazos River Authority, want to put this in place as well, just for from you guys meeting us on a meeting today and reading our proposal. This is one token of another commitment, level of commitment that we can provide. So I'll end there and open it up for questions that you guys might have or discussion.
I have a question.
Sure.
What do you see going forward with the change in administration as far as investment philosophy?
Yeah, I mean, I can comment on that, and then maybe Tom or Ned, you guys can chime in there as well. You know, it's really hard to know. I mean, there's a couple things that I'm thinking about, and how they're going to impact portfolios. You know, one certainly is inflation, and that's something we've talked about for years and years and years, since the financial crisis and the and the stimulus approach then. But I think inflation certainly is an impact and is going to impact things. As I think yesterday I just read that Biden outlined another $3 trillion sort of program. And that's just a lot of liquidity and a lot of money going into the market. So, what happens, what happens to the securities markets, both fixed income and equity markets when inflation really starts to rise? I think the Fed certainly keeps an eye on that. Of course, they're working to manage that, but I think it's a concern. And then the other is just volatility. The amount of volatility that we've experienced in the marketplace is significant. There's a lot of Americans with a bunch of cash right now, and I don't see that necessarily ending. So trying to figure out how that's going to drive the securities markets, again, both in the short term and the long term, I think it's challenging. But we have a lot of debt, we have a lot of spending happening, and at some point things, it doesn't seem like it's going to slow down with this administration. But so I guess I'm telling you, John, that we see a lot of spending happening, and I don't see that necessarily slowing the markets. But at some point, there's an overheating, I guess, in my opinion, or how I'm seeing things. So Tom or Ned, do you have any commentary on that?
In the interest of time, I think I'd refrain. Thank you for your comments, but also ask if the other members here have additional questions.
Yeah, I wouldn't add anything.
So are there any more questions for this group?
What's that?
Director Luton, were there more questions?
Pardon me, David, say again.
Are there any more questions from the committee?
Does anybody have anything they want to ask?
I do not.
All righty, then I do appreciate Tim, Ned, and Tom, your participation here. And any other closing comments?
Well, I guess I would close with, I think certainly as a firm, we would love the opportunity to serve Brazos River Authority. I think there's, we've again, know very little, but I think that just in the amount that we do know of you guys and the research that we've done, I think we could serve the authority well and work with your team well. So, if there's anything else that we can provide you guys, I know our discussion here was fairly short, and we're happy to engage and provide more information if that would be of use to the committee.
Okay.
But thank you all. Really appreciate your time and appreciate involving us in the process.
Very good. Thank you very much.
All right, guys. Take care.
All right. Bye-bye.
Thank you.
Thanks, everyone.
All right, now we discuss, I guess.
Yes, sir.
This is Director Tallis. I've got a couple of comments and just a question. First of all, just to confirm, we are ranking them today, right? We're going to rank them in order of preference.
Yes, please.
Okay, so I would put, I don't forgot the name, I would put the second presenters third. I just don't think they brought much value. They weren't very organized, and I just didn't hear anything. That's just my opinion. Regarding the last one, I really like them. I wrote down, do you change, do you change for the sake of putting a different set of eyes on things? I think that's the question I proposed to everybody, because they're all dealing with the same resources. They're all offering the same services. They're all using the same market products. And so the question at some point, I could very easily just go back with ANCO, and because I don't think they've necessarily done anything wrong. But however, is there a time that comes where you go, okay, they've been on it for an X amount of time, and now it's time to give somebody else that seems to be equally qualified to a chance to do it. And then lastly, my question, David, is what kind of vetting do we do? When y'all went from 6 to 3, what kind of vetting do you do that took you from 6 to these final 3?
Really, I was looking at their participation basically in the state of Texas. One of the firms we had, it just was quality presentation. And these three firms or my staff decided that they probably would rank 1, 2, and 3 in that group. But a couple of the firms, we didn't like the way they did their presentation or the response was made.
Do we do any background, in this whole age of the web, do we do any background searches to see if they've screwed people around or got good reviews or things like that?
No, sir, I didn't do that with these firms. So they're pretty firms.
Okay, that's all I've got.
This is Cynthia Flores. Director Tallis, I agree with your comments. David Thompson, you and your team have also done a really good job bringing us 3 firms that seem highly qualified. I have a question. This last group noted that there's a 75% securities overlap. Is that true? I mean, is that accurate?
With that comment, I've not gone back to research that, but I definitely can research that. But I think what I'm guessing they're saying is they're similar funds, and it could be those are the funds that part of the committee has selected over time too. But I don't have an answer for you. I'm sorry.
Okay, it made it sound like they were the exact same thing we were paying twice for. I'm just curious.
You can be in a fund one day, and the next 2 weeks from now, it can be invested in something another fund is invested in, and they just move money around sometimes that you're not aware of going in.
I noticed that they were Vanguard, and I'd have to look and see if that's what they're talking about, that you're dealing with the same group as an overlap, because they were all, he was addressing the Vanguard funds, and we're heavily invested in the Vanguard funds.
This is Ford Taylor. It was somewhat discerning to me that the last firm was showing that the same identical fund can be purchased for slightly less dollars, which you would think that that's part of their fiduciary relation with us, is to make sure that we're getting the best possible price. And again, I'm not knowledgeable enough to know if that's factual or not, but I would be willing to bet it is.
It is factual. And over the last couple of years, I've been pushing ANCO to find these type of funds. And yes, they're probably more that we could probably find. But matter of fact, I think they're going to bring to the next retirement committee another change too. They find a little bit cheaper, same fund, but a cheaper cost base on it. But that's a true statement. They are out there.
Well, that was disappointing.
Yes, I have a comment. If if ANCO did actually return, and I assume they did, 11 point something percent increase, well, that's going to be pretty hard to beat.
You see, you should in.
They did?
Yeah.
Okay. No.
So back to Director Tallis's question. How long do you stick with the same firm? Is it, they all do the same thing? What is your recommendation on that, David Thompson?
I like the last firm too, and it's a different approach. They just have added San Jacinto River Authority, so I have not talked to that CFO there. If you're part of the river authorities here in Texas, you know the review board, and you know the pulls and the acts that we have to deal with. ANCO has a lot more of the Texas firms here, and the committee is new. I will say this: over time, there has been a different change in philosophy and groups. Since when I joined, it was very strict, and there were difficult to make changes in some of the funds. So in the last couple of years, we've made some big changes in the funds with ANCO. So I'm indifferent between the two firms, and I'll leave it up to the committee really to decide. They're good quality firms. So
David, this Ford Taylor, are they in-house staff wise, or do we create a big problem for you all swapping from one firm to another? Does that create internal costs that I'm not thinking about on the top of my head?
yeah, I've not done a change before in the investment groups. We own that portfolio, so it would be a matter of we couldn't change the portfolio and do what the last firm was talking about without a change in the investment policy. So we would have to go through and figure out what changes they will make, and then we'd have to if they're going to make changes, we'll have to make change in the investment policy, because we're strictly investing to that policy that the committee that agreed to.
And David, this is Jeff again. How long have we had ANCO?
ANCO, we actually had Bogdan Group before.
Right.
So it's probably been 10 years.
Okay.
Now, ANCO is a different firm, and of course, we had Richard before, and that was a whole different philosophy change with Tony coming in. So it was a big fresh change that when he came over to the account too. But
well,
yes,
what kind of shape was the account that was our portfolio in when ANCO came on board?
With the Bogdan Group, it had some rocky roads in there, but I wasn't part of that group. I only came in probably Bogdan Group had been 5 years, and then I joined the last 5 years with Tony. Joined in the last 3 years. So,
John, I remember, I don't remember the specifics of the rockiness, but they were not meeting the numbers back then, and I think there was real validity to the change at that point. I think whereas now, I don't know if there's any hardcore numbers like, hey, y'all haven't, like Royce mentioned, they've had decent numbers. I just at this point, I would not be adverse to making a switch, is my opinion, to if we think they're equal, just because 10 years is a long time to be with the same people. However, I would like to contact San Jacinto just to get another River Authority's experience level, even if it's a small sample size.
I can do that.
How long have San Jacinto had them?
I think it's just recently, because I didn't see them out there before in the response. So they must just added them in the last few months.
So my opinion on that would be, why don't we let them cut their teeth with the other river authority? And then because we're a bigger authority, then we could maybe relook at them next time.
Certainly a good idea, worth thinking. David, how long is this contract for?
It's for 5 years, but there's a renewal every year, so we could set up that way too. So we could go through, get some more information, and then if San Jacinto River Authority is very pleased with them, we could actually come back to that. Another thing I can do is I can amend the contract with ANCO and move it out a little further and get a little more research and get back to board. And we could have another meeting to discuss that if you want to. It's up to you guys to do.
My opinion is a lot like Talus, where, the second one is my third choice, the last one is my second choice, and ANCO is my first, just because I'd like to see their performance with the San Jacinto Authority over time. I would hate to just reach out and say, okay, so you hired him, let's hire him too. I just want to make sure that they've fully understood the river authorities.
I would be okay with that. And Jen, Director Henderson, as you say that, with the new administration coming in, maybe that's another reason why maybe right now is not the reason to change. Although they implied, the last one did, that maybe that means an influx, but maybe that's another reason to put it off another year for consideration.
And ANCO has done a really nice job on our returns and hitting our benchmarks and stuff too.
I agree with that.
I'd be okay with that then.
So what I set up is the contract would be for a 5-year period with 1-year renewals. And then 1 year from now, we'll see where we are with them. And I can find from San Jacinto River Authority how they're doing with it, and maybe even get information from them on that too. Is that something you guys would want to consider?
Yeah. And do they have other river authorities, David?
That's the only river authority I'm aware of. San Jacinto River Authority.
Okay.
I will say, I don't know if it's a month or a year that they picked them up, but I can definitely get with Mr. Michelle, who's the CFO there at San Jacinto River Authority. I know him very well.
Do any of y'all think that if ANCO gets the feeling that we're trying or fixing to cut them loose, that they would do us as good a job for the next year or so as they've been doing? I'm just wondering.
I mean, it's
all do better.
Always,
Yeah.
but it's like a 1-year it's a 1-year prove it contract, like in the NFL. Maybe they'll come out and even do better. So.
Okay.
Yeah. I mean, we can offer them a 5-year, but they has to renew every 1 year. And I'd be more than happy to, before the renewal came up, we would sit down and discuss it and see where we are performance-wise, and where San Jacinto River Authority is too.
I'm good with that.
That'd work with me.
I like it. Do you need a motion for that?
No. I think what we'll do is then we'll continue to rank it with 1 being ANCO. That's kind of what you're discussing. And then highest is 2. And then the Dave Hobb number 3. I'm sorry.
I'm good with
Is
that.
kind of, okay. I'm not putting words in your mouth.
Feeling.
Is that your feelings?
I'm good with that.
Yes.
Do we need a motion in that, to that effect?
I think Lisa's probably busy working right now, putting a resolution together, and she'll put it up on the screen here, and I'll read the resolution to be adopted. Oh, she'll fill in the names here. Give her a second. Lisa, could you do one more thing for me? Have the 5-year period with annual renewals. Right, after you see the, for a 5-year period, and then with annual renewals. Perfect. And probably a comment after renewals. Does that look good for everyone here?
Looks good to me.
Yes.
Okay.
Read the resolution, please.
I will. Thank you, sir. Be resolved that the Retirement Committee of Brazos River Authority hereby authorizes the General Manager, CEO, to negotiate and execute a contract with Retirement Plan Advisory Services in the best interest of Brazos River Authority with ANCO Consultant for a 5-year period with an annual renewals, with the contract containing such terms and conditions that the General Manager, CEO, shall determine to be the best interest of Brazos River Authority. In the event the staff is unable to successfully negotiate a contract with ANCO Consulting, the committee authorizes staff to negotiate a contract with Highest Group LLC. In the event that the staff is unable to successfully negotiate a contract with Highest Group LLC, the committee authorizes staff to negotiate a contract with Dahab Associate Inc.
You've heard the reading of the resolution. Is there a motion to adopt?
I'm sorry, this is Cynthia. I don't like that we would go to our third option at all.
Okay, we can do that. So do you want me to reread or let's remove that and then reread the resolution one more time. So Lisa, can you take the after Highest Group LLC?
Put a period.
Period, and then remove the last sentence.
I like that better.
I guess that's why she's the chairwoman. She's smart.
Perfect. I'm very with that. All right,
And,
be resolved.
Hold on,
Oh, sorry.
you have to delete the last sentence now.
Oh, you're absolutely right. I'm sorry. And I appreciate that. Thanks. So Lisa, can you remove in the event the staff is perfect?
There you go.
Now we're there. We're good?
Yep.
All right. Be it resolved that the Retirement Committee of the Brazos River Authority hereby authorize the General Manager, CEO, to negotiate and execute a contract with Retirement Plan Advisory Services in the best interest of the Brazos River Authority with annual consulting for a 5-year period with annual renewals, with the contract containing such terms and conditions that the General Manager, CEO, shall determine to be in the best interest of the Brazos River Authority. In the event that the staff is unable to successfully negotiate a contract with ANCO Consulting, the committee authorizes staff to negotiate a contract with Highest Group LLC.
You've heard the reading of the resolution. Is there a motion to adopt?
Chair Luton, can I ask one question before we do that?
Certainly.
It's not clear to me when those annual renewals are based on how it's written. Can we change that sentence where it says best interest of the Brazos River Authority and with ANCO Consulting for a 5-year period? Those annual renewals would be inside of that 5 years, right?
Correct.
So how do we specify that?
My thought was they basically have 5 renewals in that period. Each time the contract comes up for renewal, it has to be approved.
So wouldn't it be it would be a contract for a 1-year period with a 5 we would renew it 5 times.
We can say it that way too, if you want to, yeah.
The way this reads to me, it reads that it's a 5-year contract, and then it's renewed every year for 5 years.
Yeah. I don't know, yeah, Riley was on the call here.
This is Monica. The way they write the contract is they write it for one contract for a 5-year period, and then you're not, you're re-upping, you're saying, okay, we're going to go for another year on the 5-year option, but you don't have to go through the whole purchasing piece again. So it's written this way to where it's showing that the contract can be up to 5 years, but you have to go in each year and say whether you want to continue with that contract.
Hey, this is Riley.
Thanks,
Sorry,
Riley.
I was muted. Yes, Monica's absolutely correct. That's how it's set up.
Riley, let me ask you another question. My concern is, let's say in 1 year, we decide that we do want to go back to Hyatt Group LLC.
You'd have to go for proposals.
We'd still have to go back out for proposal again?
Yeah, because we've already chosen somebody now and entered into a contract with them. We have the ability to terminate that at any time, and we have the ability to renew on an annual basis. But if you decide you're not going to renew, then you would need to go back out for proposals.
Did everybody hear that on the committee there?
Yep.
Yes, I think that's fine.
Okay. So,
okay,
Riley, do we need to reword the 5-year period with annual renewal?
Why not, Riley? Why wouldn't we say, in the best interest of the Register Authority of ANCO Consulting, for a period not to exceed 5 years, with annual renewals? Because I think that addresses Director Henderson's concern about the 5 years starting over every time we renew.
Yeah, typically the way we would word it is we would say a 1-year contract with up to an additional 4 1-year renewals.
If we do that, Riley, are we going to have to go back for proposals every year?
No. We renew it on an annual basis if you want to. It's only if you don't renew it that you would have, and you decide that we're going to go back out and get somebody else, that you would have to go out for proposals.
All right.
so with that, would it be okay to make a motion to approve the resolution and ask Riley's group to review that sentence to make sure that it jives with what we've talked about?
Yeah, I think the way I would word that, looking at it here, I would say best interest of the BRA for like I said before, the way we typically do this is we would say for a 1-year period with up to 4 1-year renewals.
Lisa, could you change that?
I'm good with that.
And then you could say for a total period not to exceed 5 years, like David mentioned.
Right. I know David he's got a good handle at what I'm getting at just based on what he said. I feel like we could go through this time and time again and spend 30 minutes on it. But if you guys could look at it outside of the meeting, I think we could move forward with it. Am I wrong there?
Well, I mean, I think the resolution needs to be accurate for you all to vote on it. I mean, we can't go change it outside the meeting.
Okay.
So did you catch that, Lisa? Change? I don't have control of the slide.
If you can repeat it, because it's different numbers, so just
Listen, hey, Lisa, so right in the middle where it says, in the best interest of the Brazos River Authority with ANCO Consulting, say for a 1 year, 1-year period. Well, I just meant the word a dash between 1 and year, sorry.
With,
yeah, just like that, for a 1-year period.
No, period.
No, yeah, like the word period, sorry. For a 1-year period with up to 4 annual, or 4 1-year, sorry, with up to 4 1-year renewals, comma, for a total term not to exceed 5 years. Comma, and then go on from there. With the contract containing such terms and conditions, general manager shall, yeah, that looks good.
Yeah, that's better.
it is better.
And you might put a dash between the 1 and the year and the 1-year annual renewals, just for proper grammar, I guess.
Thank you, Riley. For good?
Does everybody like that?
I'm good.
I do.
It's kind of like watching sausage be made, isn't it?
I'm good
Lisa's
with,
doing a good job. Lisa's doing a good job.
David, please read the resolution.
Yes, sir. Be it resolved that the Retirement Committee of the Brazos River Authority hereby authorizes General Manager, CEO to negotiate and execute a contract for the retirement plan advisory service in the best interest of the Brazos River Authority with ANCO Consulting for a 1-year period, up to 4 1-year annual renewals for a total term not to exceed 5 years, with the contract containing such terms and conditions as the general manager CEO shall determine to be in the best interest of Brazos River Authority. In the event that staff is unable to successfully negotiate a contract with ANCO Consulting, the committee authorizes the staff to negotiate a contract with Highest Group LLC.
I make a motion, we approve that as read.
I'll second.
Who made the motion?
Tallis.
Motion made by the Director Tallis and a second by the Director Henderson. Please poll the committee.
Chairman Layton,
Aye.
Director Taylor,
Yes.
Director Henderson,
Yes.
Director Leslie,
Director
Director
Leslie,
Leslie?
yeah, Leslie votes yes.
Director Tallis,
Yes.
presiding officer.
Yes.
We all in?
We're all in.
There being 8 ayes and no nays, the motion passes. Does anyone have a question about the other 2 agenda items? They're just reports.
Motion.
No, sir.
No.
All we need now is a motion to adjourn.
So moved.
Move to adjourn.
All in favor?
Aye.
Aye.
Hey, Lisa, we may need to work on, we've had more sound difficulties with this call. I don't know why.
We're on it, Director Tallis. My apologies.